there is a stream of positive news in the economy. We are seeing the GDP numbers, for one, surprise us on the upside. As well, a bunch of corporates have announced better than expected numbers. NPA resolution seems to be happening here and there. So are things turning better for the banking sector as the stock market seems to indicate? I have with me the one person who can answer at least some of these questions, whose finger is on the pulse of probably 3,000, 5,000 companies. I have with me Chanda Kochhar, Managing Director and CEO of ICICI Bank. Chanda, thank you very much. I'm inviting you in an ambience of good news, the positive GDP numbers. Is your personal micro experience gelling with what the GDP number is telling you?
Yeah, Latha, you see the GDP numbers are saying that agriculture has done well, which is indeed true. We had a good kharif crop, we had good rabi sowing. It's also indicating that government expenditure has moved as per schedule or even better, which I think is credit to the government, to be able to push the GDP growth through that route. If you look at our own business activities, well, we saw that, October was good. Maybe November people actually kind of waited, whether it was to buy homes, whether it was to buy cars and so on. But even for us, in terms of our retail disbursements, the December numbers came back quite sharply, and January numbers were almost at the October levels. So I think, what happened in November was transient in most of the cases, so to say.
Okay. Well, let me just go by the Q3 numbers that you all gave. Loan growth up to then was 5.2% YOY, but retail was up 18%. So what may you end the year with? Do you think retail will do even better than 18%, and therefore your overall number can be, at least high single digit?
Again, when you look at our growth, which was 5.3% or so, actually you have to look at our domestic loan growth. And our domestic loan growth was actually more than 12%. So we grew the domestic book at 12% vis-a-vis the system growth of 5.3%. So we're growing at almost double the industry growth. And within that domestic growth of 12%, retail is growing at 18%. Again, our growth of 18% in retail compared to the industry growth rate of around 13% or so. So we seem to be on track. Our domestic business will grow anywhere between 12 and 15%. Retail will continue to grow at around 18%. That's where our year-end numbers would be. And I would say that's still a very strong story because. As I said, it's almost double of the industry growth on an overall basis on domestic side, and much higher than the overall retail industry growth rate.
But is there a rubber band effect because there was a lull in consumption, which of course the GDP numbers are refusing to acknowledge or at least reflect? Is there a rebound? I mean, will retail end much better than 18% or even a little better than 18%?
It's possible because some of this was kind of postponed demand. So, that will get translated in this quarter. So it's possible. But anyway, I mean, an 18% kind of a growth rate is what we are running at in any case.
Okay. Now, let me come to the cost of money. How much of the deposits you think will stay?
So I think on the savings bank account, there is some amount of money that was just lying as dormant savings with people, which has come back in the system. I think that money will stay. But yes, some amount is just converting an informal economy into a formal economy because people were used to dealing with cash in some way, and now they are dealing through the formal channel. So that will go back in the economy in the regular use. So I think we've not yet reached that, clear time frame where we'll be able to project, what the behavior would be. But I do feel that some part, of the savings account will definitely stay in the system.
No, because withdrawal limits, I mean, March 13th, all withdrawal limits are gone.
So I think by then, maybe, by April or so, one should be able to really gauge how much of that system, how much of that stays in the economy. But we've already seen a substantial jump in the savings account. So clearly,
also, savings deposits up 30%. Current account was up about 16%. So what should we expect?
Overall, I won't make forward-looking statements, but I would say that clearly you would see, whatever has been a normal increase in CASA. you would see a much more increase in CASA because the step jump that took place.
Half will remain, quarter will remain.
See, it's very easy to give a very broad range. I don't want to give a very broad range, which may mean not much, but I think on savings account, more will remain.
Okay.
On current account, less will remain,
yeah.
because that will go back.
That's business money. Yes, yes. But how is all that impacting your costs or your margins, more importantly? We saw one MCLR, a series of MCLR cuts. So do you think that we should expect both deposit and lending rates to fall further, and how much more?
So cost of deposits has already come down, and more so the MCLR has come down. And we always used to debate this: when will banks cut rates and when will my EMIs come down? I think in this time round, actually the banks have preceded some of the cuts in the cost of deposits by. Rather the lending rate cuts have in that sense preceded, and banks have moved much further ahead. Because if you look at it from April 2016 till now, maybe the repo rate has been cut by about 50 basis points. Even the retail fixed deposit rates have come down 50 to 60 basis points. But the MCLR effectively has come down almost 100 basis points.
Yeah,
so I think it reiterates the point that I always used to earlier say that it's not just a repo rate cut that determines lending rate, it's the cost of deposits. And why did the cost of deposits come down? Because a lot of CASA money came in, and that's helped us cut the MCLR. So I think from here on, I would say that a large part of the lending rate cut has already taken place. We will in fact have to see how interest rates move from here. There may not be immediate cuts that may happen very soon in the lending rates, because we have to watch what RBI does to the rates, how much of CASA deposits.
That's what I was coming to. That's what I was coming to. Yeah. The RBI stance quite clearly has shifted to neutral from accommodative. The reading would therefore be that maybe they will not cut any more at all. Then what happens? Do you still see a possibility, because loan growth is weak for the system, and you yourself are saying that a part of the deposits will remain? So will the supply-demand of money being so in favor of supply of money, is there a little more for cost of money? The governor seems to think so. He said we are into neutral, but the banks will pass on. So the banks, as I said, have the MCLR cuts have been even higher than the. But he thinks there is more. He thinks there is more.
But even on the RBI stance, I think again the cost of funds depends not just on the repo rate movement one way or the other. It also would depend on the liquidity. And what the RBI stance is towards sucking out liquidity or not. So I think that also determines the cost of funds. Plus, what would determine the cost of funds is the CASA movement. How much of CASA deposits really stay in the system. So I would think it's very early to kind of predict, whether there would be further rate cuts and in which direction rates would move. I think from here on we have to watch really to see the CASA behavior before we are able to predict further.
Inflation, whatever you say, is at 3.2, 3.4, and sentimentally a saver should be okay with maybe 1.5, 2 percentage points over that. So in the market, have rates troughed out, or even without the RBI not doing anything, there is space?
Well, I would only say that if rates move, they would move on both sides, on deposit side as well as on the lending rate side. So we'll have to watch. Now, also inflation, while it's currently at these rates, actually if you look at everybody's projections for the next year, inflation is actually likely to go up a little bit. I mean, RBI has said that their target is 4%, but that's where they want to reach. The actual inflation may be a little higher. So I think we have to watch inflation, but we also have to watch what happens to deposit rates and what happens to the flow of CASA deposits. Only then will we be able to project what happens to lending rates.
Did the RBI stance surprise you?
I think the shift, the not cutting of the rates further. Actually, I was not surprised. I think that was that was not such a big surprise. In fact, in my mind, I was quite mentally prepared for that. Yes, a shift.
98% of the people we polled were not prepared.
Yes, for even the cut in the rate.
Yes. No, they expected the cut.
They expected the cut. Yeah, but I think that did not surprise me too much. But yes, the shift in stance, I think, was earlier than what was expected by the markets.
Okay, so you lost some bond gains.
Well, I think market gains are always to be looked at opportunistically.
Okay.
We got a lot of these gains in the third quarter, which was the good part of the whole story.
Well, Chanda, the discussion should have actually begun with NPA, but the GDP kind of exhilarated the mood. But now to come back to the somber questions. Let me go from the micro to the macro. Are you confident that in subsequent quarters, this and the next, you will be able to bring down slippages, albeit marginally, but will the trajectory be lower?
I think first of all, when we look at trends like this, we should not be looking at quarter to quarter to quarter trends. I think we have to look at a little larger horizon. I would say that slippages will happen, but yes, if we would look at the whole year, I think FY18 should be better than FY17. But that should not be taken to interpret that the first quarter would turn out to be much better. But overall, if we look at it, I would still think that when you look at a horizon of a year as a whole, yes, there should be some improvement.
Steel prices are rising. Maybe those guys have enough EBITDA to at least pay some more loans. You are saying that there is probably a consumption rebound. At least all this is not even giving you the satisfaction or the comfort that last time the additional slippages were 7,000 crore. This time it will be 6,990. Even that kind of confidence is not there.
Well, I think that is,
No, I'm only asking for the direction. No, I'm asking you directionally.
Yeah, but at the same time, I must also say, yeah, directionally, as I said, one should see that one is moving in the positive trajectory. But at the same time, what happens is that many of these cases are lumpy accounts for the banking system, and if one case turns NPA, in that quarter the numbers go up substantially. So whether you are able to settle that case this side of March or that side of April can make a difference to quarter-wise numbers, and therefore I always believe that one should not be looking at trends on a quarter-wise basis. Yes, steel prices are going up. Yes, these companies are servicing part of the interest. But I think overall the system really has to focus more and more on resolution.
Okay. What's coming in the way? Do you think that because of the arrest of some bankers, things have gotten paralyzed in decision making?
No, I think again on this whole thing, I must say that the good news is that everybody is not now talking about resolution. Otherwise we were in the past only talking about recognition and provisioning. And when you look at NPAs, there are three parts to it. There's recognition, there's provisioning, there's resolution. I think recognition, a lot has happened. Yes, slippages will still continue to happen, but we've got moving on the recognition cycle. Provisions, according to me, are actually a consequence of recognition. So we should look at resolution. And the entire system, the regulators, everybody is focusing on resolution. Yes, indeed, resolutions are moving slower than what all of us would want them to move. Many reasons for it. First of all, these cases themselves are complicated. The large cases, even when you go to sell a large unit, you have only that many few buyers who have the capability to buy the unit. Second is the entire ecosystem is also complex. It's not just about the banking system. It's about whether all the approvals come in on time, then there would be a value in asset. Whether you get the mine that was taken away, then there would be a value in asset, and so on and so forth. So the rest of the ecosystem also has to move in tandem.
Of course.
And the third, of course, is the banking system itself. The ability of the banking system to take decisions on time is also very critical for these resolutions to move. So I think it's a combination of all these things that is resulting in resolutions taking longer than what we all would desire.
Of course.
But that's not to say that resolutions are not happening. I think, some of the large deals that have been announced that are likely to get consummated soon only mean that, some large resolutions which India has not seen so far in the past are also taking place.
You don't have much of steel now, no? You sold off your SR Steel exposure to NERC.
I don't talk of company-specific things.
No, I'm looking for this sector.
We sold off some part of steel sector, but we still have some part of steel sector in our own books.
Okay. What is the public sector nature of banks a problem? I mean, is it that you are willing to sign off on an unsustainable debt and public sector banks are not able to because they have to worry about a CVC and stuff like that? Is that a problem?
Well, I think finally the issue is that in every company there are almost 18 to 20 banks.
Yes.
So, whether you break them into segments or not, the issue is that all the 20 banks have to be able to decide. So even if 10 banks decide,
so I think
60%
50% by value is enough.
Well, 50% by value is not enough any longer. Especially if you have a new buyer coming in, the new buyer needs to have everybody on board, because otherwise they don't want to come into a situation where then they would be left handling the rest of the banks. So I think it is important that decision making is more kind of consolidated, comprehensive, because that's
but
what
is this the issue? Is this that because state-owned banks have this problem of the 4 C's, as the chief economic advisor said, CVC, CBI, courts, is that the stumbling block?
Well, I think that's also an issue. So yes, as we look at the entire ecosystem, we have to address that part as well. But as I said, it's not about one reason. It's about so many of these parts which are complex in the entire ecosystem.
But the new deputy governor has proposed something like a private asset management fund and a national asset management fund. Did you ponder over it? Is that helpful? Or do you see that even progressing?
See, my firm belief is that any structure that gives us resolution is what we should pursue. So, it's, as many structures that we think of, I think that's very good. Finally, the details are, the devil is in the details. Of
but did you all discuss
implementation happens? Yeah, so I think, even if you look at that speech, I think the positives of that speech are that he's saying, let's focus on resolution. Let's focus on putting assets back into productive use. Let's focus on bringing back capital.
No. Did you all discuss that, since you were there on the dais at IBA? Has the RBI or the government or Viral Acharya himself taken it forward?
So many of these structures and similar structures have been discussed in the past also and are being discussed now as well. As I said, finally what we should do is whether the assets remain with the banks or whether they remain in a separate structure, and whether that separate structure is a different bank or an AMC kind of an institute. I think we have to empower whoever is holding the loan with ability to decide and resolve. That is where that structure will work. So to me, I think we should debate all these structures, and finally whatever is the structure where decision making can move is what we should make it happen. Doesn't matter what form it is.
My own hope is that we don't debate and we just go and do something, because I think we've debated enough. But one issue of
doing is not the doing is not just about creating a structure. The doing is about
resolving.
Making sure the structure can resolve.
One specific issue where you don't have to put a very big structure. You all are in an advanced stage in Bhushan, perhaps, in SR. In several instances, probably there is a buyer, probably there is a sustainable debt that is identified, or unsustainable debt that is identified. He's asking for a rating of those, so that, the market says that this is a sustainable asset. Is that something you all are taking forward? Is that workable?
So what we are actually discussing is that, there has been, even in the past, a very simple resolution mechanism called the CDR. So, we could just look at moving under that mechanism, making sure that under that structure joint decisions take place and they get implemented. Again, the flexibility in that structure is in a way similar to the speech that was made, that you don't have to really focus on what exact percentage of the loan can be sustainable or not sustainable. You arrive at whatever is sustainable. Handle the sustainable part in a sustainable manner, handle the rest of the part in different formats, and keep moving forward.
So is that what you're asking RBI, that allow us to not provide for the sustainable part in the CDR mechanism? Is there?
So no, provisions apart. I think what we are all discussing is that can we then start moving under a kind of a CDR mechanism and look at just deep restructuring without having to stick to specific percentages as being sustainable.
No, if you read Viral Acharya's speech, it's very clear that the regulator's discomfort is when free hand was given for restructuring. Probably, if either loans were evergreened or the can was kicked down the lane. So that is why that if we give you more liberty to restructure, then you have a rating agency say that this is sustainable. That seemed to be the regulator's condition.
So two things here. One is that having a rating agency opine on it is always very good, because that gives the market even more confidence, and so one is not debating that at all. But to debate whether the restructurings of the past were good or not, I think also has to be juxtaposed along with the way economy moved vis-a-vis how it was expected to move. So, every time you make a structure, you make certain assumptions on how growth will happen, how economy will move, how the project will move, how the approvals will come, and then you have to go back and see whether those assumptions came into play. If the assumptions themselves don't come into play, then
it looks like everything.
Yeah, then the solution obviously will not work.
So, what is the regulator saying? Are you expecting some tweaking?
So we are in dialogue. Let's hope that soon we get some answers.
Okay, let me just speak about power a bit, because other than steel, that is the place where there are problems. Are things turning around? I mean, are T&D losses coming down? Are DISCOMs servicing loans? Are power generators finding buyers?
Power. See, I think we have to, in power sector, we have to break this up into two: the past projects and the newer projects. Well, on the newer projects, I think one thing that's happening is the cost of power production, or the cost of power, is coming down substantially. So in that sense, that's a positive for the consumers. But I think the past projects, those issues are still taking time to resolve. Yes. So, either some where the debt is high, or some where the raw material linkage has been taken away, or somewhere the tariffs haven't changed. I think those projects, those resolutions have not yet happened. So we have to look at those projects in a very different manner than the new production case.
So now banks are the owners of JP Power under SDR. You already have over 50% ownership of that project. Are you all sure to find buyers? What is the chances of finding a buyer soon?
So the concept of SDR means that the banks would have more than 50%.
Yes, of course.
So wherever we exercise SDR, that's what it means. And also, I think the second concept is that whenever we exercise SDR, we do it with saying that there should be some solution in mind. So yes, again, there are solutions in mind, but the banks have to work on it. And as I said, the resolutions are taking time. But indeed, there's some plan, there is some solution that the banks have in mind.
Okay. No, the dilemma appears to be that, the new buyer is given a haircut, and at that time the old promoter says, give me a smaller haircut and I'll do it. Is that how you expect that would you prefer the old promoter?
There cannot be a generic answer to this. I think on this, again, we have to look at project by project. We have to look at promoter by promoter. We have to look at the credentials of the new buyer. We have to, then compare the offers from not just one new buyer, maybe many new buyers, the existing promoter, and so on. And I think, again, all of it cannot be a number game. It also has to be an offer, and how credible is that offer. So that's why, one, I can't give you a generic answer, and the second is that's why these solutions are not very easy.
But JP Power, you think, will be at least a solution that you will find that banks are confident of?
Let me not give you a company-specific answer.
No, it is fresh, and it's not a gas-based plant. That's why I'm asking you.
Yeah, but as I said, I mean, when banks exercise SDR, it's obviously with a direction and a solution in mind.
Okay. Well, let me just end this painful part by asking you, your total stress. You already have your drill down list. You have, SDR. You have your S4A. If you put that entire list, I think it came to some 11% or something. Will that stress number at least look lower in fourth quarter, in the next quarter? Is that number likely to come down? I think it came to about 11% of your total book.
Again, Latha, we must remember that these are ratios. So ratios are dependent on both the numerator and the denominator.
Exactly what I meant.
So,
will you grow your way out is what I'm asking.
Yeah, but then that, you have to look at the credit growth in the system. So, you should again not grow for the sake of growing and pick up any credit for the sake of adding to your asset base. So, I think the right approach to follow in this scenario would be, one part, look at the stress, focus on resolution. The other part is, look at the credit growth. Of course, grow to the maximum opportunity, but not grow recklessly just to grow your assets. The ratio will be a result of two. And as I told you, we are not letting go of any opportunity of growth. We are growing at, our domestic book is growing double of the industry average. Retail is growing at 18%, and we'll continue to grow that. But, we'll not adjust our growth just to adjust our ratio.
No.
We'll follow good growth on one hand, and we'll focus on resolution on the other hand, and let the ratio be a consequence. Yeah,
but ratios are important. Like, for instance, will your credit cost in the current quarter and in the next quarter start falling? Have you peaked out in credit cost?
See, again, don't ask me quarter-wise, but directionally,
year-wise.
yes. But, quarter-wise, you should not really ask for. And the credit cost is also a result of aging. So, so the credit cost always starts coming down with a lag, because what you recognized, you still have to provide aging provision. So you should not expect credit cost to come down.
It'll fall after the stressed assets fall. Certainly. Okay, you this time also had the advantage of the listing of your life insurance unit. Should we expect the Lombard listing also anytime soon, your general insurance?
Well, we've said
the markets are looking so good.
Yes, I think, the confidence that we have is that we've created fantastic franchises. Each one of these companies are now, standing up in their own right with creating their own place in the market universe as well. Life insurance company has shown that. So, clearly we have a candidate available. Which way do we monetize a little bit more? Which way do we create pricing benchmarks? I think are left to us. But, you can't rule that out. There's nothing that we are planning immediately, but you can't rule that out. We'll keep looking at monetizing a little bit more from these subsidiaries, and we'll keep looking at finding, the way we monetize to create more and more market-related benchmarks.
And even ICICI Home Finance is available for...
See, actually, that's a very small company in that sense. In fact, there we keep getting some interest off and on, but that's a small company. Yeah.
Okay. One way to grow, of course, is inorganically. Should we expect something on those lines?
I've always said that, we are always open to look at opportunities that come, at the right time and the right form. But at the same time, the focus always has to be that whether these opportunities come or not, your organic growth model should be robust. And I think our organic growth model is very robust. So we are focusing on that. beyond that,
No, I'm not disputing that. I'm just
Yeah.
saying that there is a big bank which the government owns 26% either through SUTI or through, LIC, through other units. Have you thrown your hat in the ring?
I don't know what is the ring, first of all. So you
No, you couldn't. You can always approach the government and tell them that I am willing. Have you?
There's nothing that we are discussing as of now, but I don't ever comment on market speculation.
No, it's not speculation. This is very clearly a bank available, and you have friends there. You will be able to, have an easy conversation. If others are asking, would you not also want?
So as I said, Latha, never comment on market speculations.
It's hardly a speculation. I can tell you, I've spoken to people. I mean, am I speculating? You tell me the truth. Am I speculating? I know people who have actually called the government and said that they are making the offer or that they are interested. So, I mean, I'm asking you, if somebody else is phoning, will you also not phone the government?
Well, as I said, a lot of these things that you're saying could only be imagination of the markets as well, could be imagination of the media as well. But, let me not get into any of these market speculations.
All right, Chanda Kochhar, it's a pleasure speaking with you, but I wouldn't be surprised to see ICICI much bigger, not necessarily through organic growth, right? It's a good guess. Okay, thank you very much.
Thank you.